Welcome back, everybody. This is Jay Martin, CEO of Cambridge House, and my next guest is Tony Greer, the macroeconomic analyst and editor at the Morning Navigator. Now, Tony is very active in the market and on Twitter, actually, and I strongly recommend you follow him at TG Macro because he's equally entertaining as he is educational. Why I wanted to have Tony on the show today was to gauge his sentiment on the commodity sector. This is where he spends a lot of his time, and coincidentally, where I spend a lot of mine and my capital. So we dove into the inflation versus deflation arguments, what he sees coming in the future, and how he's allocating cash accordingly. This is a very interesting conversation. I really hope you enjoy it. Right beneath this video, there's a pinned comment. It's a free newsletter and I publish every week. I love writing it. But first, Tony Greer, the editor of the Morning Navigator. Enjoy.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Tony Greer, macroeconomic analyst and the editor of the Morning Navigator. Tony, it's great to have you on the show.
Thanks for reaching out and having me, Jay. I'm excited to talk about the markets.
Yeah, well, I'm glad you can make time. Now, it's my first time having you on. So for anybody that watches my show that's not familiar with you or what you do, why don't we start just with a high level? What do you spend your time doing, Tony?
Absolutely, Jay. So, I have a publication business and a consulting business essentially at TG Macro. My publication business is, the bulk of that. I spend time writing the Morning Navigator newsletter, which gets published on Mondays, Tuesdays, Thursdays, and Fridays. I do a video at the end of every week for my clients called the Icebreaker. So that's like a 5 to 10 minute market video that comes with your subscription and gets you caught up to date every weekend. And then I have another package where it includes a Slack channel and some other high-level analysis reports at the end of every month. And what I spend my time doing really, Jay, is digging into my network, my vast network of clients, and how it's grown has been really important to what's going on in the world right now. The ability to reach out to people in the commodity trenches, in addition to getting the information off the screens has been really, really important. And so really writing the newsletter and trying to, what I do is I navigate into and out of a lot of transportation, energy, and commodity positions. And, I kind of dictate that as I go in the newsletter. And, the rest of my time, like I said, I spend talking to clients, and we have a couple of other verticals in our business, but we'll leave it right at that for now. And so managing that is really a full-time job and something that I luckily absolutely love doing. I've been writing about markets for 25 years now. I've had a sort of formalized approach at following them for about 15 or 20. I turn that into my, analysis product and writing my content. Writing about markets is really my passion. So I am thrilled and grateful to be able to do this for a living for the last 5 years since launching TG Macro right after the 2016 election.
Got it. Okay. Thank you for that. Now, I thought an interesting place to start would be, I use this content very self-servingly. If I'm curious about a subject or topic or something I don't understand just yet, I have guests on that help me pick those ideas apart. In addition to like stress test a thesis that I'm really bullish on or whatever. But the dominant conversation on my channel right now, Tony, and on all of my peers' channels is the inflation debate. And you can go a couple of directions with this: inflation, deflation, transitory inflation versus runaway inflation, whatever it is. But that's where the jury's kind of out. And so where do you stand, first of all, Tony? What's your perspective of what's happening right now with consumer prices and the longevity of all this?
Yeah, well, I think, I try to separate in my mind the difference between, headline inflation signals, and commodity inflations and commodity trends, right? I try to separate that out because when you talk about inflation, we come to measuring it by, the BLS statistics, CPI, PPI, et cetera, and we go back to, what's been taken out of that number over time, right? We know that just just to encapsulate that whole conversation, we know that there are costs that are rising that are not being calculated in CPI. So similar to that, in CPI, when you've got things trading off inflation, you've got the bond market that is going to trade off inflation, and then commodities that are going to kind of do their own thing, right? And that's how I sort of separate the markets. We saw it very clearly this week. I tend to think, to get to your point, I tend to think that the commodity inflation is going to be lasting. I like to believe in another super cycle, kind of like the one I witnessed from 2000 to 2010, when China was inhaling commodities with both hands at a regular pace. And, now the commodities that they were inhaling are all putting up cities in, all around China and floating around on their Navy. So that was interesting to see. I think we're headed, coming out of the COVID situation, the COVID lockdown, into what's going to be a very tight market for commodities. I am a believer in the lasting inflation, right? So what I see is really, Jay, you nailed it. It is a bifurcation of the transitory inflation argument that the Fed presents. And then it is we disagree with the Federal Reserve's transitory argument that Paul Tudor Jones, Jamie Dimon, and Jeremy Weir, the CEO of Trafigura, the biggest commodity trading firm in the world, have come out and said.
Yeah.
So I tend to side with the guys that are in the trenches, like the CEO of Trafigura, who expects potential 10-year bull market in commodities himself. He talks about the strain that the new green movement is going to put on metals and metals pricing. And so that's kind of the lane that I've been going down in following this inflation trade. And as you can see by what happened this week, all of this is very much tied to the dollar, right? So that the metals side of the commodity trade is very much tied to the dollar, starting with gold, right? So this week, what we saw when Jerome Powell came out to sort of prove to the world that the inflation they were seeing on their screens 2 weeks ago was transitory.
Yeah.
And he came out, and market-based inflation expectations, like the yield curve and like break-evens, backed off. Gold got absolutely bludgeoned, right, in a series of really steep, large magnitude moves, and everything metal came apart, right? Yeah. So we had that take place, and I think that was the Fed saying, like we said, coming out of the FOMC, we think this inflation is transitory. And the gold price at $1,750 is much different than the gold price at $1,900. And I think that they, and China probably as well, have figured out that a rallying dollar can put real heat, let's call it this way, take real heat off of the inflation trade and knock some of the high-level speculators out of it, right? So we're going to be, I think the commodity trade continues. I think I call it the Bloomberg Commodities Index, right? Primarily made up of energy and base metals and precious metals and grains. But I think that that commodities continue to rally. What we're going to see, though, is central banks managing the visible inflation, right? So when gold chirps up and gets towards, towards 2K or something like that, they may reverse the dollar, which is something that they do regularly, intervening in the FX markets. And they know that that puts a cap on gold and sort of calms down the inflation conversation. And what they had go along with that trade this week was 5-year break-evens broke off, 5 and 10-year break-evens back off in the treasury market. Mm-hmm. The treasury curves, 5s, bonds, 2s, 10s, pick a segment. It all is so signaling less inflation, less economic activity. And I think that's what's playing out right now. What's amazing is that, this all started when the everything shortage cover hit Barron's.
Okay.
Right. You remember that? That was a couple of weeks ago, I think. And, as soon as that became the front page trade, China came out after that and said that they were going to manage metals prices by metals over a course of time, which they've done before. They actually did that in 2010 when we were coming out of the great financial crisis. right? And commodities started rallying and commodity markets got hot. And, China tends to still be a big buyer. So it's really important to understand that we can see China's cards in this trade, right? In copper, there are 24 million tons produced each year in copper globally. China produces 1 million tons and consumes 14 million tons. So, China can say that they are going to sell base metals all they want. Net, they are still going to be a huge buyer of base metals, right? In the US, as we pivot to the green movement, right, with the Joe Biden administration, we're going to have 600,000 electronic vehicles, in the government fleet in a year or so. They're going to require a lot more base metals and minerals, right, to build batteries and things like that. So we're going to have a huge, consistent draw on base metal demand. And so, China can try to calm down this trade for a little while. Jerome Powell can get gold bombarded and take the heat off of the inflation trade for the time being. But physically and structurally, the markets are still set up to rally. And I think that that's what's important for traders to follow. I think that, we're going to see the natural bid to natural resources, and we're going to see central banks try to manage that when the speculation gets excessive. And then we're going to see a natural bid come back, So that's what I see happening, Jay. I see it kind of back and forth over the next 5 to 10 years. A lot of the charts technically have broken out of long-term downtrends, like the Bloomberg Commodities Grains subindex.
Yeah.
Something, very cognizant about within the commodity trade is that grains are breaking out of a 10-year bear market, potentially into a new bull market. And, that's going to affect everyone's grocery bill. So that's right. If you noticed in the commodity rout that took place this week after the Federal Reserve, oil was still up 1%, right near the highs. Oil is 71.50 bid on the New York close, like $1.50 from the highs of the move. Mm-hmm. So energy is not affected by this base metals bombarding, right, that's going on. So I think that's important to observe, that the commodity market stayed intact. Jerome Powell probably took a lot of heat off of himself by saying that inflation is transitory because the gold price is back to $1,750. So I think that that's how this is going to be managed. And you want to put your money where, mostly where things can be, it sounds like the energy market is going to be riding north as far as my estimation has been and continues to be. I've been a long-term energy bull and I remain an oil bull. So, things like that are the commodity ships that I want to attach to, to sort of stay out of the way of Jerome Powell. And that's how I'm looking at it.
Yeah. Okay. I love that, Tony. And there's a ton to unpack in there. Thank you. Yeah. So, I love what you just, quickly mentioned about the CPI. It is very misleading, especially it's important to note how many, ingredients have been pulled out of the CPI since like the 80s. Key things like energy and food. Am I right? Not included in the CPI.
CPI number, right? Exactly.
That's wild. It makes sense that you shouldn't put a lot of faith in that number.
More importantly, healthcare, education, things like that, right?
So what should the CPI really represent these days then?
Yeah, I think it covers, a lot of manufacturing type of data, like car tires and barbecues and things like that, and washer dryers. I think it kind of covers a lot of run of the mill.
Okay.
A lot of, automobiles. Well, there's automobiles as well. A lot of things like that have seen deflation over the years thanks to technology, right? I just bought a truck for $40,000 and to replace the last one that I bought 20 years ago for $40,000. And I've got a much better truck, right? So you can see that the cost of making the trucks has gone down because the weekend that I'm buying a truck for the same price.
Yeah.
So there are deflationary forces all over the place. But there are also inflationary forces all over the place as well.
Yeah. Yeah. Okay. I want you to help me understand one concept you touched on. So if I understood this correctly, central bank will be watching, commodity prices like inflation indicators and essentially using the dollar as the gas pedal or the brake right, by playing in the FX market to strengthen the dollar, weaken the price of gold, which a lot of us look at to either verify or dispute our inflation thesis. So how does that work, Tony? What can you share on how that functions?
Yeah, just following the narrative, I think, Jay, is indicative of what goes on. So we just saw commodities rally for a year out of the March lockdowns, right?
Wow. Yeah.
So as commodities, what's a conspicuous one to me is copper.
Okay.
Right? It's on the front page of everybody's radar right now because it's such a huge component in the green energy movement, right? It's very important in batteries and wind farms and everything. All of it takes tons of copper. So when we look at the copper markets, copper has just rallied from, a lockdown low of, I think, 4K on the LME to 10K, right? This is all-time highs, LME 10K in copper, right? 10,000 per metric ton, $10,000. The curve in copper is backwardated, which means supply is tight. The curve meaning when you go out the calendar in copper, the near price is the dearest price on the screen.
Right. Okay.
What that is indicative of people using copper as inputs wait until the last minute to buy it because the price gets away from them. So they hope that it comes back, but they wait until the last minute until they need copper. And what that generally does is push the immediate price up above the rest of the curve, right? So if we think about that for a second, we're going into the green movement where we're going to be increasing dramatically, like 3 to 5x the amount of copper that we consume.
Right.
We're going into it with the price of copper at all-time highs, and we're going into it with the inventory shelves kind of bare, right? It doesn't sound like people implementing the green movement are going to care about the copper inventories or the price of copper, right? They have an agenda to get us off fossil fuels.
Mm-hmm.
That agenda is going to help, it's going to need more and more copper to build more batteries and put us onto the green economy. So that kind of draw to me is going to be really conspicuous of something that the Federal Reserve is not going to have any control over, right? I do not think that they're going to be able to press the price of copper lower. But what's interesting is that once the price got to the highs, China came out and said, okay, we are going to be managing the price of base metals to cool off this rally, right? We're going to be selling them over a period of time, and that's just jawboning. But the market takes it seriously and backs off a little bit.
Mm-hmm.
None of the uptrends have been broken, right? Nothing has changed about the physical side of the market. China just said they wish it to be lower. Right? Like we know, they can say that they're going to be a seller of copper from their strategic reserve, but they're net a consumer of 14 million tons a year. So stop their economic activity and stop consuming it in order not to make that dent and maybe make the price come off. Not likely to happen.
Right. So it's just posturing, but it's enough to scare the market.
Definitely. What it does, and then, sometimes it was very conspicuous to me to see China come out and manage the base metals price. Shortly afterwards, Jerome Powell comes out and manages the gold price, right? So what was interesting when China made that comment about metals, they were in the markets selling yuan and buying dollars. Right. There were some major moves in dollar yuan when China came out and said that they were going to manage the metals markets. So what that does is adds dollar strength to the international tape. Right. The dollar index then starts rallying. Then Jerome Powell comes out a week later and sounds maybe a little bit hawkish, talks about tapering, talks about rate hikes at the last FOMC, and the dollar is through all resistance levels. Right. So when you look at what they just did, and then look at the screens, they really, really took the heat off of the inflation trade in the markets.
100%.
They backed gold off. They backed yields off the highs. They put the curve back in its cage. They put everything, the stock market even backed off, everything in Bitcoin backed off, everything inflation hedge wise went down this week.
You're right.
So see what happens from here.
Right. Okay. So yeah, what about some of these alternative asset classes like Bitcoin? Do you have any thoughts? I mean, we're watching this correction now. Do you think Bitcoin's going into the next 3-4 year crypto winter like it did after the 2017 rally? Do you have any thoughts on that, Tony?
Technically, I do for now still. Yeah. Technically speaking, Bitcoin closing under its 200-day moving average for a couple of weeks now, as a technician, that's a problem for Bitcoin, right? So we also, so my scenario in Bitcoin, Jay, is that I've been kind of waiting to buy it. I think it's going to be something that's going to fit into the macro landscape. More importantly, I think the blockchain and NFT technology is something that's going to be with us forever. And so I don't want to miss out on that, Yeah. Price-wise, though, it still seems like Bitcoin has to work off the most excessively bullish sentiment I ever witnessed in a security.
Yes.
Right. We had 5 sentimental tops that I was watching when Bitcoin was trading 60K. Mm-hmm. 5 of them.
What's a sentimental top, Tony?
So sentimental top is when sort of things can't look any better for the asset class.
Okay.
Right. So I'll count them up. We had Elon Musk buy $1.5 billion in Bitcoin. Right. We had the Miami Heat rename their arena in Miami after the FTX Bitcoin exchange. Right.
Yeah.
We had the Beeple JPEG, which is nothing but a photo, trade $70 million on auction, right? We had everyone on Twitter put laser eyes into their avatar when Bitcoin went 65K bid, because in their minds, they were talking about 100K like it was going to happen before breakfast.
Yeah.
So they got excessively bullish there. And then what was the bell ringer? Coinbase went public. And Bitcoin never trade higher again, right? Then we had the technical washout that we knew was coming after all of those sentiment bell ringing type of signals, right? So now it's into a sensible level that I can at least entertain. And it feels to me like we just lured a lot of people in above 40K again. Bitcoin traders tend to be milestone traders. And when it got back up above 40K, I think they got very excited, and we saw a lot of positive commentary that drove it there.
Okay.
And as you can see, it failed again. So that looks to me like there's going to be some trapped longs up in the 40s again in Bitcoin, and then it's got room to back off. But I think somewhere in, with another puke on the tape is when I'm going to be looking to buy it again. That's kind of how I'm looking. I still think that there's going to be merit to it within the inflation trade, if that's fair to say.
Yeah. Okay. I'm with you, and I feel like I've positioned myself in a way that kind of reflects that sentiment, right? Like I dollar cost averaged in for maybe the last, year and a half. I wasn't early to Bitcoin by any stretch, but decided a year and a half ago I needed a horse in the race.
Yeah.
I didn't want to be aggressive, didn't want to lose sleep over my position. And obviously in a correction like today, I'm grateful for that, right? And, I watch cycles for a living too. And it's like, okay, no chart looks like that. Well, we know what happens when a chart looks like that, I guess. Right. And all the meme culture, the laser eyes, you said it, the have fun staying poor, the rhetoric. it got so cultish and crazy. Which turns a lot of people off, and I think that's unfortunate, right? Because it's a funny culture to ingratiate yourself with. It's not, it's a bit strange sometimes. Yeah. Okay.
Yeah, I can't ever buy into the magic carpet to wealth thesis.
Of course, yeah, of course, that's the issue. 100%.
Yeah,
100%. Yeah,
that's my main. If I had to just kind of cliff note it, that would be it.
Okay. One commodity we haven't talked about yet is uranium. And I want to get your thoughts because, I'm seeing public sentiment shift towards nuclear a little bit. And, for most of my life, it's been very negative, right? It's been the ugly stepchild in the energy sector because of really three significant, but only three crises that have occurred. And that's been enough to black label the nuclear sector to a large degree. But do you have any thoughts on uranium moving forward, Tony?
Yeah, I have to tell you, Jay, I'm in the bleachers as a spectator of uranium, so you know. $1 invested in it, and that is because I'm a fossil fuel guy. So I've been led to that space when my favorite commodity traded zero, right? So that's where my energy focus is. But I will say in uranium, from a spectator side, I will say that some of the smartest traders I know have done a ton of homework in the space and put it in front of me, and it's voluminous to the point that I haven't even gotten to it. But I believe what they're telling me, that they believe in this sector. And personally, if you ask me, it's going to be it's the most efficient source of energy the world's ever known. And so we should probably figure out how to harness it. I think the whole thing is a safety issue. I understand that. But at the same time, it seems like something that we should be able to work around, and I'm not sure what the answer is there. So I guess once you can get around uranium as being a huge security issue and being, a potential environmental risk, then I think you've got an all-star energy product on your hands. The problem is I don't know the route to that. I don't know the path to taking the stigma off of it and the path to which it becomes environmentally acceptable, right? That's my struggle. But I'm a believer in the long run. I just don't know the path at all.
Yeah, very similar. Yeah, strong believer in the technology. It's low carbon footprints, high output energy source. We've had some catastrophic failures that have resulted in public sentiment being incredibly poor. And, I'm seeing that shift this year. And then what was it last week? There's a leak occurring at a Chinese plant right now, and we're just going to have to wait and see how the media treats that, right?
Exactly.
Yeah. Okay. So look, I think I have a good grasp of your inflation thesis. Essentially, you're betting on inflation, but in a non-linear fashion, right? And you're going to watch the dollar to determine how aggressive to be, right?
Well, a little bit, yeah. I'm watching the dollar to be, to figure out that's kind of my speedometer, if you will. Okay. I don't trade the dollar. I don't trade bonds. I trade a lot of transportation, energy, and commodity stocks. So I let the macro readings be my speedometer, if you will, Jay. When the dollar is under pressure and under pressure technically, I know that I've got that wind in my sail to step on the gas in some of my energy trades or some of my other commodity trades if I can. So, and at the same time now, I just stopped myself out of about a half a dozen positions on trailing stops as the dollar went higher, and the metals stocks, mining stocks, and steel stocks that I owned backed off into support, right? So I sold those for a profit on the way down. This way I can buy them back. But, it was all on a trailing stop from metals trades that I had on a while ago. So this was a big take profit week for me in the down waterfall. And this gives me a chance to, readjust my sails to this trade and figure out how to stay in it where Jerome Powell can't get me killed.
Yeah. Okay. And then backing up, Tony, what can you share about your overall portfolio strategy? When you take profits out of the market, how do you reinvest? Do you hold hard assets, or how do you distribute your wealth accordingly?
Hard assets, absolutely. I have a vault full of gold and silver, for a long time that, is something that's more of an insurance policy. Yeah. A sliver of my wealth that I don't, one of those things you don't plan on selling, kind of thing. Other than that, I've really shifted my portfolio personally into, I have to say, a much more natural resources based versus technology based portfolio, and I'm getting run over in this type of adjustment right now where, FANG goes through the roof without me. Right. And, some of the other subsectors of technology look really good again. And I'm not positioned in those. So I got a problem if they take off. But at the same time, I'm still comfortable trying to get positioned in what I think are going to be secular bull markets in ag and base metals and maybe steel and maybe even gold metals and mining once we get through this period. But at the same time, I want to stay out of Jerome Powell's way. So I'm really going to be focusing on energy and ag for the next, probably for the next quarter. That's going to be my focus.
Got it. Okay. Awesome. Tony, look, I appreciate your time. Thanks so much for coming on and getting in front of the audience.
Anytime, my man. If anybody needs to reach me, you can find me at tony@tgmacro.com. Send me an email, or my website is www.tgmacro.com. And I'm on Twitter at tgmacro if you need to track me down. But thanks for having me, Jay. I appreciate it.
Yeah, my pleasure. As always, if you enjoyed this content, please hit subscribe. I'd love to have you on the team. And if you want to take the next step and go a bit deeper with my content, I publish a free weekly newsletter every Friday where I debrief my portfolio. I distill the top lessons I've uncovered from the guests I've had on this show every week. And I talk about sectors and industries that I think are poised to move, areas that I'm looking for opportunity, and places that I'm allocating capital. I love writing it. We publish every Friday. The link is right beneath this video. Love to have you join the tribe.